acquirer shall retrospectively adjust the provisional amounts recognized at the acquisition date. Additional assets or liabilities may also be recognized during the measurement period. Uh, and at the same time, uh, if new information is obtained about facts and circumstances that existed as of the acquisition date that, if known, would have resulted in the recognition of those assets and liabilities as of that date. The measurement period ends as soon as the acquirer receives the information it was seeking about facts and circumstances that existed as of the acquisition date of or learns that more information is not obtained. So usually, we may refer this to most often liabilities and your equity accounts. Now, however, the measurement period shall not exceed 1 year from the acquisition date. So only 1 year from the acquisition date. The measurement period is the period after the acquisition date during which the acquirer may adjust the provisional amounts recognized for a business combination. The measurement period provides the acquirer with a reasonable time to obtain the information necessary to identify and measure the following as of the acquisition date in accordance with the requirements of PFRS 3. A. The consideration transferred, which may have provisional amounts. Any non-controlling interest in the acquiree, previously held equity interest in the acquiree, in the case of a business combination achieved in stages that we have already taken up here. The identifiable assets acquired and liabilities assumed and the resulting goodwill or gain on a bargain purchase. The acquirer recognizes an increase or decrease in the provisional amount recognized for an identifiable asset or liability by means of a decrease or increase in goodwill. So if you can recall in our illustrative problems that when it was discovered later after the date of acquisition that the building has a greater fair value as of the date of acquisition. The building has an increase in fair market value. So in that connection, the entry was to debit back building and to credit back goodwill, which you have initially debited. In other words, the adjustment is to be recognized in by means of a decrease or increase in goodwill. So don't be surprised why there is a building increase. How come that you are crediting goodwill? Why is there a building decrease? No, you are going to debit back goodwill. So for that purpose, that answers our question. During the measurement period, the acquirer shall recognize adjustments to the provisional amounts as if the accounting for the business combination had been complete at the acquisition date. Thus, the acquirer shall restate comparative information for prior periods presented in the financial statements as needed. After the measurement period ends, any revision on the accounting for a business combination shall be treated as a correction of error that is accounted for under PES 8. We have already taken this up in intermediate accounting 2 when as we have to remember that the measurement period is only good for 1 year. Once it ends, then we have to treat correction of error. Now we have the provisional amounts, identifiable assets acquired. On September 30, the ABC acquired all of the identifiable assets and assumed all the liabilities of XYZ by paying 1 million. On this date, the identifiable assets acquired and liabilities assumed have fair values of 1,600,000 and 900,000. So assets and liabilities of XYZ company. So in case number 1, identifiable asset recognized at provisional amount, ABC engaged an independent valuer to appraise a building acquired from XYZ. However, the valuation report was not received by the time ABC authorized for issue its financial statements for the year ended December 31, X1. As such, the building was assigned a provisional amount of 700,000. Also, the building was tentatively assigned an estimate useful life of 10 years from the acquisition date. ABC uses the straight line method of depreciation and recognize 3 months depreciation on the building in 20X1. On July 1, 20X2, that's the following year, ABC finally received the valuation report from the independent valuer, which shows that the fair value of the building on September 30, X1 is 500,000 and not the 700,000 that was the provisional amount. And the remaining useful life is only 5 years and not 10 years. So now we can see the changes. But take note that the report of the independent valuer was given on July 1, 20X2, and it is still within 1 year after the date of acquisition. So that takes a 1 year period. How should the ABC account for the new information obtained? ABC should retrospectively adjust the provisional amount assigned to the building. The adjustment shall be charged to the goodwill recognized on acquisition date. Depreciation expense shall also be retrospectively adjusted. ABC shall then restate its 20X1 financial statements and provide the disclosures required. Now take note that on September 30, the acquiring company paid 1 million. And on that date, the net value of the net assets is 1.6 million and 900,000. So the net identifiable assets has a net value of only 700,000. That's net of liabilities. So in other words, by that time, there was a difference between the consideration of 1 million and the net book value of the assets and the liabilities, showing that there was a recorded goodwill in the amount of 300,000. That was because the building was assigned an amount of 700,000. However, based on the report of the independent appraiser, the building should have been recognized only at 500,000 and a different remaining life. It's only 5 years. So we now have the measurement period adjustments. The consideration received is 1 million and the no controlling interest, no previously held equity interest. So the consideration is 1 million. We deduct from it the fair value of net identifiable assets of 700,000. So there was goodwill recognized on September 30, the date of acquisition. However, based on here, we have your adjusted fair value of the net identifiable assets. Fair value of identifiable assets acquired, then we deduct the provisional amount assigned to the building, 700,000, but we add the fair value per independent valuers appraisal. It's only for 500, or you can merely deduct 200,000. So that gives the adjusted value of the identifiable assets of 1.4 million, and then we deduct the fair value of liabilities assumed. So we have the adjusted fair value of the net identifiable assets acquired of only 500,000 and not 700,000. Okay, and not 700,000. So, how should ABC account for the new information obtained? Retrospectively adjust the provisional amount and charge to goodwill recognized on acquisition date. Depreciation expense shall also be retrospectively adjusted for restatement purposes. So the measurement period adjustments are computed as follows. The unadjusted goodwill is 300,000 that was recognized as of the date of acquisition. The adjusted fair value of the net identifiable assets acquired in lieu of 700,000. It's only for 500,000 because of the decrease in the value of the building. So finally, we compute for the amount of the goodwill after appraisal of the building. The consideration is still 1 million, and the fair value of the net identifiable assets is 500,000, so that the correct amount of goodwill is 500,000. Now, the original amount recorded for goodwill as of September 30, being the date of acquisition, was only 300,000. The adjusted amount of the goodwill is 500,000. So we have to increase goodwill by 200,000. The adjustment to depreciation expense recognized is computed as follows. Our depreciation expense was initially computed in the amount of actually the original value of the building recognized was 700,000. Then we divide it by 10 years. Then we divide it by 10 years and multiplied by 3 over 12. 3 over 12 is September 30 up to December 31. So the amount of depreciation recorded was 17,500 in 20x1. The adjusted amount of depreciation based on the appraisal of the building is 500,000. We divide it only by 5 years and multiply it by 3 over 12. So the adjusted depreciation for 3 months is 25,000. The amount recorded was 17,500. So in other words, we have to add depreciation in the amount of 7,500. So our adjusting entries for the measurement period We now debit on July 1. July 1, debit to goodwill for the additional goodwill and credit to building for the decrease in the value. The original fair market value was 700,000. The adjusted fair value is only 500,000. So we have to credit because of the decrease in the value of the building. So to record the adjustment to the provisional amount assigned to the building. Provisional was 700,000. Then second entry will be to debit to retained earnings for 7,500 because of the have to adjust to the building account and as well as its accumulated depreciation. So we have now your case number 2 for that purpose, where we have to make adjustments to the building account. Okay, so we have this is the meaning of an adjustment retrospectively. In other words, the adjustment should be reflected to your retained earnings account. The retained earnings account, the only account open because for 20x1, the books were already closed and so the nominal accounts were already closed. However, when we talk about goodwill and building, they are still open because they are real accounts. So this is now the first illustration as with regards to. Then we go to case number 3. In case number 3, the information obtained beyond the measurement period. Now take note that in our previous example, the information that the building's fair value has reduced, no, to only 500,000. The information was obtained within the measurement period. Kaya nga, July 1. And the measurement period extends up to 1 year. But in this case, the information obtained was obtained beyond the measurement period because it was obtained on November 1. So ang 1 year period is only up to September 30. The internal auditors discovered an error on the recorded identifiable assets acquired from the business combination. A patent with fair value of 100,000 and remaining useful life of 4 years as of September 30 X1 was omitted from the valuation listing. So in other words, you got the patent account. How should ABC account for the new information obtained? So the new information obtained about the patent, that the patent should be an adjustment for that matter because the new information is obtained after the measurement period. ABC should account for the new information in accordance with past 8 as correction of a prior period error. Past 8 requires the correction of a prior period error to be accounted for retrospectively and for the financial statements to be presented as if the error had never occurred by correcting the prior period's information. So the correcting entry on November 1 will be to debit patent 100,000 and credit to goodwill. Again, we go back to any adjustment because of the difference between the provisional amount and the present fair values based on the independent appraisal. So any change in the fair value is to be treated as an adjustment to goodwill. So we now debit again to retained earnings for 100,000 divided by 4 years times 3/12. That would pertain to the unrecorded patent is nonetheless recognized, but this time not as a measurement period adjustment, but as a correction of error. Goodwill is charged for the correction of error because if ABC had known the existence and value of the unrecorded patent on September 30, the amount of goodwill that should have been recognized on that date is 200,000. So if the amount of goodwill should have been recognized on that date. So within the period, it's no longer within the period of 1 year. Now, determining what is part of the business combination. Determining what is part of the business combination transaction. Before the business combination, the acquirer and the acquiree may have pre-existing relationship, or they may enter into transaction during the negotiation period that are separate from the business combination. It could be possible that they are related of example, um, franchisor, franchisee relationship, or in whatever other areas, no? So as long as they have pre-existing relationship, or they may be having supplier customer relationship. So, the acquirer shall identify amounts that are not part of the consideration transferred on the business combination. In applying the method, the acquirer shall recognize only the consideration transferred on the business combination. Separate transactions shall be excluded from the consideration transferred and accounted for under other relevant PFRS. Okay, a transaction that is arranged primarily for the benefit of the acquirer or the combined entity rather than primarily for the benefit of the acquiree or its former owners before the combination is likely to be a separate transaction. So if it is for the benefit of the acquiree or its former owners, and not for the benefit of the acquirer or the combined entity. So that would mean a separate transaction. Thus, the portion of the transaction price shall be excluded from the consideration transferred when applying the acquisition method. PFRS 3 provides the following guidance when determining whether it's a transaction that is part of a business combination or a separate transaction. First, we have to identify the reasons for the transaction. A transaction that is arranged primarily for the benefit of the acquirer or the combined entity rather than primarily for the benefit of the acquiree, so acquiree or the combined entity, no, rather than primarily for the benefit of the acquiree or its former owner before the combination is more likely to be a separate transaction. Thus, the portion of the transaction price shall be excluded from the consideration transferred when applying the acquisition method. On the other hand, a transaction that is arranged primarily for the benefit of the acquiree or its former owners before the combination, more likely to be part of the business combination. So, a transaction that is arranged primarily for the benefit of the acquiree or its former owners before the combination, okay, will be considered as part, not before. But in the first paragraph, a transaction that is arranged primarily for the benefit of the acquirer or the combined entity rather than for the benefit of the acquirer, of the acquiree, no? Or its former owner, to the extent that before the combination is more likely to be a separate transaction. Okay, party initiating. A transaction initiated by the acquiree is more likely for the benefit of the acquirer or the combined entity and therefore is more likely to be a separate transaction. On the other hand, a transaction initiated by the acquiree or its former owners is more likely a part of the business combination transaction. So, initiated by the acquiree, no? A transaction, party initiating the transaction. A transaction initiated by the acquiree is more likely for the benefit of the acquirer or the combined entity and is more likely to be a separate transaction. Okay. Excuse me, I just would like to clarify some things that, okay, that's the last part of, okay, please make correction. Party initiating the transaction. A transaction initiated by the acquirer. Make correction, please. Party initiating the transaction. A transaction initiated by the acquirer, ina, is more likely for the benefit of the acquirer or the combined entity and therefore is more likely a separate transaction. On the other hand, a transaction initiated by the acquiree or its former owners is more likely a part of the business combination transaction. Now we go back to the previous sentence, determining reasons for the transaction. Reasons for the transaction. A transaction that is arranged primarily for the benefit of the acquirer or the combined entity rather than primarily for the benefit of the acquiree. Okay, please make correction. A transaction that is engaged primarily for the benefit of the acquirer or the combined entity rather than primarily for the benefit of the acquiree or its former owners. Okay, or its former owners before the combination is more likely to be a separate transaction. I am now correcting the statement. Kay man daw may double line diri. I repeat, a transaction that is arranged primarily for the benefit of the acquirer or the combined entity rather than primarily for the benefit of the acquiree or its former owners. Okay. I-delete inang statement nga kay nagdouble or the combined entity. Okay. Basahon ko liwat ha. Reasons for the transaction. A transaction that is arranged primarily for the benefit of the acquirer or the combined entity rather than primarily for the benefit of the acquiree or its former owner or owners or its former owners before the combination is more likely to be a separate transaction. Again, a transaction that is engaged primarily for the benefit of the acquirer or the combined entity rather than primarily for the benefit of the acquiree or its former owners before the combination is more likely to be a separate transaction. Thus, the portion of the transaction price shall be excluded from the consideration transferred when applying the acquisition method. On the other hand, a transaction that is arranged primarily for the benefit of the acquiree or its former owners before the combination is more likely to be a part of the business combination transaction. Then party initiating the transaction. A transaction initiated by the acquirer is more likely for the benefit of the acquirer or the combined entity and therefore is more likely as separate transaction. On the other hand, a transaction initiated by the acquiree or its former owners is more likely a part of the business combination transaction. Then we go to the timing of the transaction. We have the timing. A transaction between the acquirer and the acquiree that takes place during the negotiation of the terms of a business combination is more likely to have been entered into in contemplation of the business combination. Now we have the examples of separate transactions that are not to be included in applying the acquisition method. A. Settlement of pre-existing relationships between the acquirer and the acquiree. B. Remuneration to employees or former owners of the acquiree for future services. And C. Reimbursement to the acquiree or its former owners for paying the acquirer's acquisition-related costs. Okay? So, this ends module number 2.
Excuse me, ma'am.
Yes.
Ma'am, wala na state, ma'am, ang case number 2. Kay nagdiretso dabi, ma'am, sa case number 3.
Ang case number 2.
2, oo, ma'am.
Ang kaina nga kwan nga case number 2. Page 15. Then, nag-proceed kita sa case number 3. 15. Sa ano to no? Sa measurement period. Illustration number 1. Case number 1. Identifiable asset recognized at provisional amount. Okay? At provisional amount. So, bali, case number 1 lang. Kag 2.
Ang, oo, ma'am, tas ang
Ang
number
3, amo na
3,
ang 3. Oh. Case
okay.
number 3
Okay.
is case number 2. Wala na case
Thank
number
you, ma'am.
Okay? So, any question before I move on? I have to discuss goodwill in chapter 3 or module 3. Take note that most of these topics I am discussing or all of these are in the book of Dayag. But Dayag has more. No? Gani nga ang mga fatman nga ina, daw ay ko na ikakita kay Dayag lang. Pero, nawala man gid na fatman. Kay siling ko ano na iyang fatman, sir, ang balya dugang-dugang lang na. Para maayawan ka mo tuon na. Okay, we go to module number 3. Module number 3, the module includes accounting for goodwill. We have been talking about goodwill. Halin pa sang nagligad. Accounting for goodwill, accounting for reverse acquisition, and combination of mutual entities. Now, only goodwill that arises from a business combination is recognized as an asset. Goodwill arising from other sources, like the internally generated goodwill, is not recognized. The amount recognized as goodwill is determined on the acquisition date of a business combination. Subsequent expenditures on maintaining goodwill are expensed immediately. Subsequent to initial recognition, goodwill is not amortized but rather tested for impairment at least annually. So not tested only for impairment at least annually. For this purpose, goodwill shall be allocated to each of the acquirer's cash-generating units in the year of business combination. If the allocation is not completed by the end of the year of business combination, it must be completed before the end of the immediately following year. Cash generating units is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or group of assets. Goodwill shall be allocated to the cash generating units expected to benefit from the synergies of the business combination. The methodology used to assign goodwill must be reasonable, supportable, and applied in a consistent manner. For example, goodwill may be allocated based on the relative fair values of the cash generating units. So in case 1, the applications through direct valuation method. EBC is contemplating on acquiring XYZ. The following information was gathered through a diligence audit. The actual earnings of XYZ, and you have the following information gathered through a diligence audit. So we have years 1 up to 5 with the total of the earnings equal to 6,900,000. Okay. Then earnings in 20x5. Okay, earnings in 20x5 include an expropriation gain of 400,000. The fair value of XYZ's net assets as of the end of 20x5 is 10 million. The industry average return is 12% and probable duration of excess earnings is 5%. So, okay, we have now method 1, multiples. Multiples of average excess earnings. The multiples of your average excess earnings. Under this method, goodwill is measured at the average excess earnings multiplied by the probable duration of the excess earnings. So multiplied by the probable duration of the excess earnings. Okay. The total earnings for the last 5 years as computed is 6,900,000. That's the total earnings for the last 5 years. Then we deduct the expropriation gain of 400,000, the normal earnings for the last 5 years, 6,500,000. We divide it by 5 years, the average annual earnings of 1,300,000. The fair value of the acquiree's net assets of 10 million, then we have the normal rate of return of 12%. In other words, the normal earnings is 1,200,000. So the excess of the average earnings over the normal earnings is 100,000. That's the excess of the average earnings over the normal earnings. So we now get the excess earnings equal to 100,000, and you multiply that by 5, that gives you goodwill. So goodwill is taken by multiplying your excess earnings by the number of years. And we find excess earnings as the difference between the average annual earnings and your normal earnings. Ano ba yan? Anong gawin? So we have now your goodwill computed in method number 1. Then we have goodwill computed in method number 2. Method 2, capitalization of average excess earnings. So we have now the excess earnings of 100,000. Then we divide it by the capitalization rate given at 25%. So the goodwill is 400,000. In method number 3, capitalization of average earnings. Under this method, the average earnings are divided by a predetermined capitalization rate to estimate the purchase price of the business combination. The excess of the estimated purchase price over the fair value of the net assets represents goodwill. Here, the capitalization rate is 12.5%. How does this differ from the previous? Ang previous, we only capitalize the excess earnings. And so we get goodwill. Here, we capitalize the average earnings. not the excess earnings, but the average earnings, and we capitalize and we get the estimated purchase price. We deduct the fair value of the net assets, we now get goodwill. We get goodwill. Notice that excess earnings is used here for in the computations. Uh, if the excess earnings is used, the amount directly computed is goodwill, just like this. We have to capitalize excess earnings, and capitalizing, we instantly get goodwill. But in method number 3, we are capitalizing your average earnings. So capitalizing average earnings will give us the estimated purchase price. We are going to deduct the fair value of the net assets, then we get goodwill. Method number 3. Method number 4, presented value of average earnings. So we have now under this method, goodwill is measured at the present, not present value. Present value of average excess earnings. Present value of average excess earnings discounted at a predetermined discount rate over the probable duration of excess earnings. Assume a discount rate of 10%. So again, we have excess earnings of 100,000 and we multiply that by the present value factor of an ordinary annuity at 10% with an N of 5. So here we are using the present value method. And we have now those are the 5 methods in determining goodwill. So take note, if you can recall, you have already taken this up in partnership accounting when you were computing for goodwill upon the admission of a new partner. Okay, so we have methods 1 to 4. Now, the second objective that we have in the chapter is to study uh, reverse acquisition. In a business combination accomplished through exchange of equity interest, the acquirer issues valid entity that issues its equity interest. However, the opposite is true for reverse acquisition. In a reverse acquisition, the entity that issues the securities, the legal acquirer, is identified as the acquiree for accounting purposes. While the entity whose equity interests are acquired, the legal acquiree is the acquirer for accounting purposes. So it's the reverse. For example, ABC Company, a private entity, wants to become a public entity but does not want to register its shares. To accomplish, ABC will arrange for a public entity to acquire its equity interest in exchange for public entities' equity interest. In the example above, the public entity is the legal acquirer because it issued its equity interest, and the private entity is the legal acquiree because it issues equity interest, no? Or the equity interests were acquired. However, when applying guidance provided under PFRS 3, the public entity is identified as the acquiree for accounting purposes, and the private entity is identified as the acquirer for accounting purposes. Now measuring the consideration transferred. Here, in substance, the accounting acquiree usually issues no consideration. Usually issues no consideration to the acquiree. Instead, the accounting acquiree issues its equity shares to the owners of the accounting acquirer to enable the accounting acquirer to obtain control over the accounting acquiree. As such, the acquisition date, fair value of the consideration transferred by the accounting acquirer shall be measured as an amount based on the number of equity interests the legal subsidiary who would have to issue to give owners of the legal parent would have had to issue to give owners of the legal parent or the accounting acquiree the same percentage of equity interest in the combined entity that results from the reverse acquisition. Okay, so the last portion here with regards to your measuring the consideration transferred. Measuring the consideration transferred in connection with your reverse acquisition. So that, again, we have to think of the case of your reverse acquisition, that the acquirer becomes the acquiree and the acquiree becomes the acquirer. In that case, take note that the acquiree is the one that issues shares of stocks to the acquirer. In that
Excuse,
connection,
ma'am.
yes, I'm trying to look for some statements that may have been typed. Any question?
Ma'am, sa reverse acquisition bala, ma'am,
Oo.
ma-ask ko tani, ma'am, about sa purpose of issuing consolidated financial statements. Kay sin o name, ma'am, ang ibutang sa babaw ang company.
So we can think of the consolidated company that case because the purpose of the private entity is to become a public entity. So in that
Yes,
connection,
ma'am.
since ABC company would want to become a public entity, however, it does not want to register its shares. So in that case, ABC now will arrange for a public entity to acquire its equity interest. So in the example above, we can see that the public entity now becomes the legal acquirer. Baliskad na. The public
Yes,
entity becomes the legal acquirer because it issues the equity interest, and the private entity there becomes the legal acquiree because its equity interest were acquired. No, gin-acquired kay nga si acquiree amo na ang nag-issue sa equity interest. However, if you have to look at the guidance in PFRS number 3, the public entity is identified as the acquiree only for accounting purposes. And the private entity is identified as the acquirer for accounting purposes. So in that connection, we can still say that the name of the company will still be ABC. The only thing there is it will be questionable because lack of consideration for that purpose. But the issuer of shares is the accounting acquiree. Amo nang nag-issue. The accounting acquirer is the legal subsidiary, but it is actually the legal parent. the fair value of the notional number of equity instruments that the accounting acquirer would have had to issue to the accounting acquiree to give the owners of the accounting acquiree legal parent the same percentage of the ownership interest. The fact that the private entity is not registering, it's not registering. So, if it carries its name as a public entity, then how could it continue because it has not registered officially? So, it's only an internal arrangement between the public company and the private company, for that matter, that for me, the name of the company should be that of the public entity. To avoid the shall we say kay nga si ABC in that case ABC is unlisted mo ang aton nga acquirer nga real amo na ang parent bilang unregistered siya. So si ABC amo na ang wala malis, no? So to me, daw kadelikado nga ang private company mag-carry siya sang iyang nga ngalan and call it a public entity. Kay wala siya ma-register. So for that purpose, posible nga ang ngalan niya nga dalon iya ni public company para nga hindi siya madakpan in regards to lack of registration. But in that case, si public company may ara din siya nga daan nga registration for its own initial business. I-include yan na lang si private company for that matter. Pero may mga internal papers kid sila, di fact nga ang legal nga parent si private mo. Ang legal nga parent si private. Ang si public amo na bilang ang acquiree. Now we have an illustrative problem here to follow. By the way, let's try to analyze. Issuer of shares in conventional, the issuer of shares is the acquirer. And in reverse, the issuer of the shares is the acquiree. With reference to combining constituents, the accounting acquirer, who is the legal parent, to the accounting acquiree, who is the legal subsidiary. Ina sa conventional. Sa reverse, the accounting acquirer is the legal subsidiary. Amo na ang acquiree ta. And the accounting acquiree is the legal parent. Now, how about the measurement of the consideration transferred? In conventional, the fair value of consideration transferred by the accounting acquirer. Here is the fair value of the notional number of equity instruments that the accounting acquirer, who is the acquiree actually, the legal subsidiary, would have had to issue to the accounting acquiree, who is the legal parent, to give the owners of the accounting acquiree the same percentage of ownership in the combined entity. So, bali makombine gid sila gani. So, ang imo to nga question, kay sino nga ngalan ang dalon? Is it the name of the private or the public? Okay. So, on January 1, X1, XYZ, an unlisted company acquires ABC, a publicly listed entity, through an exchange of equity instruments. So, ang public di sa ABC. ABC company issues 5 shares in exchange for each ordinary share of XYZ. All of XYZ's shareholders exchanged their shares in ABC Company. Therefore, ABC Company issues 40,000 ordinary shares in exchange for 8,000 ordinary. So, ang public sa ABC, ang private sa XYZ. So actually, ang acquirer dapat si XYZ, ang acquiree si ABC. But what happened? Si ABC was the one that issued shares to the stockholders of XYZ on a 5:1 basis. The fair value of each ordinary share of XYZ is 200. The quoted market price of ABC's ordinary shares at that date is 40. Now, the statements of financial position of the combining entities immediately before the combination are shown below. So, ang ABC, amo ni ang accounting acquiree. Si XYZ, amo ni ang accounting acquirer. That now becomes a subsidiary. Kaya nga, siya lang ang gin-issuehan sa shares. So, identifiable assets of each. Then we have the liabilities and the share capital. Ang kay ABC, 10,000 ordinary shares at par. Ang kay XYZ, 8,000 ordinary shares at 100 par. And the retained earnings of each. So we now have the total liabilities and equity of both companies. The fair values of ABC's identifiable assets and liabilities on January 1, 20X1 are the same as their carrying amounts. Required, compute for goodwill or gain on bargain option. Compute for goodwill or gain on bargain purchase. So we now get the computations for XYZ now. Let itself acquired in legal form to gain control over the legal acquirer in substance. So diri ang XYZ naton amo ang legal subsidiary. Pero siya gid actually ang acquirer. Si ABC amo ang acquiree. Here, XYZ in legal form for it to gain control over the legal acquirer in substance. Okay, so compute for goodwill, gain on bargain purchase. So how much now is the amount of goodwill that should be included by ABC and okay. The legal form XYZ Incorporated now lets itself be acquired in legal form. So amo na siya dapat ang acquirer. For it to gain control over the legal acquirer. For it to gain control over the legal acquirer in substance. So in legal form of the agreement, XYZ lets itself be acquired. ABC issues 40,000 ordinary shares. So we have now ABC issues 40,000 ordinary shares to XYZ Incorporated shareholders in exchange for all of XYZ Incorporated's 8,000. Ang outstanding shares na XYZ 8,000 ordinary with a par of 100. Ang iyaya ni XYZ amo na ang 8,000 shares gin-issuehan ni ABC sang 40,000 ordinary shares to XYZ Incorporated. Okay. Now, in legal form, ABC issues 40,000 ordinary shares to XYZ shareholders in exchange for all the 8,000 shares outstanding. Okay. In substance of the agreement, XYZ gains control over the legal acquirer. After the combination, XYZ gains control because it now owns 80% of ABC. Nga nag-80%. Kaya ang initial nga shares ni ABC, 10,000 lang. Gindugang ang 40,000 shares nga gin-issue ya kay XYZ. So that would mean 10,000 plus 40,000 is 50,000 shares. 40 over 50. That means 80%. It's actually owned by XYZ company. So, in reality, XYZ company now has the control because it owns 80% of ABC. Now, the accounting acquiree, ABC company issues shares. Ang iyang actual number of shares now is 50,000 shares. 10,000 nga initial, 40,000 nga gin-issue kay XYZ. So, muna nga, kung nga as XYZ owns 80% of the equity interest of ABC. When computing for goodwill on a reverse acquisition, the consideration transferred is computed based on the number of equity interests the legal subsidiary or the accounting acquirer would have had to issue to give the owners of the legal parent or the accounting acquiree the same percentage of equity interest in the combined entity that results from the reverse acquisition. I'll repeat the statement. When computing for goodwill on a reverse acquisition, the consideration transferred is computed based on the number of equity interests the legal subsidiary or the accounting acquirer would have had to issue to give the owners of the legal parent or the accounting acquiree the same percentage of equity interest in the combined entity that results from the reverse acquisition. So we now compute the accounting acquirer's issued shares in the reverse acquisition. XYZ's currently issued shares. XYZ's currently issued shares is 8,000. XYZ's currently issued shares is 8,000. We divide 8,000 by 80%. We divide 8,000 by 80% as we have computed earlier. Divide 8,000 by 80%. So 8,000 divided by 80% means 10,000 shares. 10,000 shares. The 10,000 shares XYZ initially owned. And out of 10,000, 2,000 will now go to, that will be the interest of ABC. So nga ang nag-2,000, 10,000 minus to 8,000. So ang interest na XYZ, 8,000, 80%. 2,000 will be the additional shares to ABC. Okay, if the business combination had taken the form of XYZ Incorporated issuing additional ordinary shares to ABC's shareholders, XYZ would have had to issue 2,000 shares for the ratio of ownership interest in the combined entity to be the same. So gani nga 8XYZ 2 ang kay ABC. XYZ shareholders would then own 8,000 of the 10,000 issued shares that will be for the equivalent of 80% and that of ABC for 20%. The consideration transferred is computed as follows. The consideration transferred is computed as follows. Shares of XYZ effectively transferred to ABC. Will you copy this? Shares of XYZ effectively transferred to ABC is 2,000 shares. Then we multiply this by the fair value per share of XYZ shares. We multiply this by the fair value of XYZ shares of 200. So that the fair value of the consideration transferred is 400,000. The fair value of the consideration transferred is 400,000. From 400,000, we deduct the fair value of the net identifiable assets acquired. We deduct the fair value of the net identifiable assets acquired. That of 1.6 million minus 1.3 million. 1.6 million minus 1.3 million, it gives us 300,000. So 400,000 minus 300,000, we get the difference as goodwill. 400,000 minus 300,000, we get the difference, and that is goodwill. Since the requirement is to determine goodwill. So again, goodwill is the difference between the consideration received and the book value of the net identifiable assets. So we now get goodwill equal to 100,000. Okay, now the last in our objective for module number 2 is combination of mutual entities. Combination of mutual entities, PFRS 3 defines a mutual entity as an entity other than an investor-owned entity that provides dividends, lower cost, or other economic benefits directly to its owners, members, or participants. We have a mutual insurance company, a credit union, and a cooperative entity for our examples. Mutual entities may be differentiated from other types of businesses on the basis that members are both consumers and owners. They are both customers or consumers and owners. Members generally expect to receive benefits from their membership, normally in the form of reduced fees charged for goods and services or patronage dividends. So usually, in a credit union, you are an owner, but you can also borrow and you can also buy from the store that will allow you to get dividends. The portion of patronage dividends allocated to each member is often based on the amount of business the members did with the mutual entity during the year. When two mutual entities combine, the acquirer gives member or equity interest in itself in exchange for the member interest in the acquiree. Consideration is transferred, but its fair value is not readily determinable by reference to a market. In such a case, the acquirer determines the amount of goodwill by using the acquisition date fair value of the acquiree's equity interest instead of the acquisition date fair value of the acquirer's equity interest transferred as consideration. Okay, so we now have a short example of combination of mutual entities. ABC and XYZ are cooperatives. January 1, X1, the two entities combined with ABC identified as the acquirer shall issue member interest to XYZ. As a result, members of XYZ become members of ABC. An estimated cash flow model indicates an acquisition date fair valuation of XYZ as an entity of 1 million pesos. The fair value of XYZ's identifiable assets is 800,000. So fair value of assets. Compute for goodwill and provide the acquisition date journal entry. Now we have the consideration transferred 1 million. We deduct the fair value of net identifiable assets. So we now have goodwill of 200,000. Debit identifiable assets acquired, we debit goodwill, and we credit the account member interest issued. Now take note that this is a cooperative. So we have the amount of 1 million. Now this ends module number 3. And if you are still there, I am going to take up the multiple choice answers to the multiple choice problems, no? So anyway, instead of giving you only the letter answer, I will still involve computations before we arrive at the letter answer. So we now go to the multiple choice problems at the back of chapter 1. Okay, everybody, the multiple choice problems at the back of chapter 1. We have a lot of problems here. Okay, number 1. I will no longer read the problem, but I will just refer to the choices. So I will no longer read the problem, but I will just go direct to the choices and give you the supporting computation for the letter answer. Okay? So everybody, you open your books. You open your books. So wala na kita naga-canvas, naga-zoom na lang, and then you open your books for multiple choice problem number 1. Okay, everybody? Are you still there?
Yes,
Ah,
ma'am.
sige lang.
Yes,
Total
ma'am.
gapong ko man lang da kamo, pwede man kamo da kakaon kung makaon kamo. Hindi lang ya ako kay budlay na kung magkaon ko. So kamo ya, Anyway, kay class, I hope you understand, medyo daw pila na lang kasi mana bilin ta tatlo na lang. And I am trying to, kung pwede lang, we take up all problems for your benefit. So I hope you understand why we are extending time, though anytime you can eat, because you are just in your, some of you are still in your beds. Pwede man kamuda, ha? Okay na? Anyway, if you want to quit, you can quit man. Kamu lang da kabalo ah. Okay, so we now begin with multiple choice problem number 1. Is more of a theory. Your answer is letter C. Acquisition-related costs are costs the acquirer incurs to reflect a business combination. Okay? So this cost under PFRS 3, the acquirer is required to recognize acquisition-related costs acts as expenses in the periods in which the costs are incurred and the services are received, with one exception. The cost to issue equity securities are recorded as debits to APIC. So debits to APIC, but in letter C, the cost of registering and issuing the certificates are deducted from the fair market value of the common stock. So that would mean debit to APIC. Okay? In number 2, up to number 6, number 2, calculate the amount of consideration transferred. And the answer to number 2 is B as in boy. The amount of consideration transferred is 7,694,440. How do we get this? Consideration transferred includes cash to former shareholders. Cash to former shareholders, 5 million. Market value of stock to former shareholders, 2 million. Market value of stock to former shareholders, 2 million. Next, present value of cash, contingent consideration. By the way, if you have questions, take them down this afternoon or evening, and then you ask me tomorrow. Okay? Para nga makadiretso lang ko. So, add present value of cash, contingent consideration taken by multiplying 4 million by 25%, 4 million times 0.25 times 0.69444. So 4 million times 0.25 times 0.69444. So that gives 694,440. 694,440. So the total consideration transferred is 7,694,440. 7,694,440. That's your consideration transferred. Okay? So that's your answer to number 2. Requirement number 3 is calculate the goodwill. Calculate the goodwill. So let's continue after number 2. The consideration transferred in number 2 is 7,694,440. And then we deduct, okay, the following. Add or deduct. Okay. Market value of current assets, 2,100,000. 2,100,000. Property, plant, and equipment, 3 million. Property, plant, and equipment, 3 million. Identifiable intangibles on DJ's books. Identifiable intangibles on DJ's books, 7 million. Identifiable intangibles on DJ's book, 7 million. Next, previously unreported intangibles. Previously unreported intangibles. Advanced production technology. Previously unreported intangibles. Advanced production technology. 170,000. 170,000. Okay naman, dali naman ako. Hiway naman ni Kwande. Kung may mapamit nga bag-o, di na. Di lang. Okay? So we have now your previously unreported intangibles, advanced production technology, 170,000. Next, non-competition agreements, 70,000. Non-competition agreements, 70,000. Customer contract, 50,000. 50,000. Then current liabilities, negative 1 million. Current liabilities, negative 1 million. Long-term debt, negative 5,800,000. Long-term debt, negative 5,800,000. Negative. Next, previously unreported warranty contractual obligations. Previously unreported warranty contractual obligations. Previously unreported warranty contractual obligations. Negative. Okay? So the net amount that you have to deduct from the consideration is 5,310,000. 5,310,000. 5,310,000. So you have goodwill of 2,384,440. Letter C. Letter C. That's the answer to number 3. Next, number 4.
Ma'am, excuse ma'am.
Yes?
Ma'am, gautututod kadaan, ma'am. Mamangkot ng kutan niliwat, ma'am, kung ano ang gindala mo, ma'am, sa unreported ng mga intangibles, ma'am.
Unrecorded nga?
Ng mga items, di ba lang, ma'am, sa dalom?
Yan nga unrecorded?
Ang sa mga...
Anay ka, siling ko, kopya lang ka mo anay, tapos, kay balaan mo kung ga-interrupt nga naga-question, madula ang aton nga continuity, Ti hindi takon katapos by 1 o'clock. Ang himuon by 12. Ang himuon ko by 12, ma-end gid ako kay 3 hours na. Ma-end gid ako kung may mabilin, ihatag ko ang letter answers. Ti maayawan kamo. Lain nga kung gahatag ako solusyon, wala labot letter answer, at least magaydan kamo. So, kung may ara kamo mga questions regarding the solution I'm giving, suptan nyo lang kag you ask me tomorrow. Kay buwas, ma-meet manggid kita. Okay lang? Ha? Okay lang? Okay lang o kung hindi? Kay kung karon, kung mag-entertain gid ako questions, siguro ang matapos ko up to 12 o'clock, number 9 lang. Kay duro gid ni kadamo, duro gid kadamo. So if you will allow me, I will just keep on giving you the solution, but tomorrow I will entertain questions. So we will have continuity and hopefully makatapos kita kung diin lang ang number. Okay lang? Ha? Is that okay? Is that okay? Okay, class, can you hear me?
Yes, ma'am.
Yes, ma'am.
So is that okay? Sino itong namangkot bagulang?
Ako, ma'am.
Sino
Pearl.
ni?
Pearl, ma'am, kay gautod-utod kadaan sa amon, ma'am.
Te, subong ga utod-utod. Anyway, in record ko man niya. Karon open nyo lang inyong nga YouTube. Ha? Okay lang?
Yes,
O
ma'am.
makontinue na ko. Kay balaan mo, na-notice ko kung may ga-question, kag mautod ang paghatag ko, lawig-lawig ang mga solutions. Pero tomorrow, tandaan nyo ang question kag pamangkuton nyo ko, balikon ko. Para nga at least ang aton nga output daw damo man. Ha? Okay lang? Continue na ko, hindi pa.
Okay na, ma'am.
O sige. Number 3 pa lang to. May number 4. The total assets after the acquisition. So, number 4, nga total assets, duro man ni kadamo. Ang total assets, okay, are the following. Total assets, 62,400,000. 62,400,000. Okay. 62,400,000 plus 2,100,000 plus 3 million, nantawan nyo da inyo libro, plus 3 million, plus 7 million, plus 170,000, plus 70,000, plus 50,000, plus 2,384,440, minus 400,000 nga direct cost, minus 200,000 nga cost to issue, minus 5 million nga cash consideration, plus unreported intangibles of 170,000 plus 70,000 plus 50,000. Then we deduct 290,000 cash paid na. So, ang imo nga total nga assets is letter C. Number 4 is letter C. 71,574,440. In number 5, the total liabilities. The answer to that is letter B, as in boy. The total liabilities Number 5, the answer is B as in boy. Okay. 6,500,000. 6,500,000 plus 30 million plus 1 million plus 5,800,000. Iwanon ko liabilities. 6,500,000 plus 30 million plus 1 million plus 5,800,000 plus 280,000 nga contractual obligations plus 280,000 nga contractual obligations plus 694,440 plus 694,440 nga present value of cash contingent consideration. So 694,440. The answer is B as in boy. Okay, we go to number 6. Stockholders equity. The answer is boy. The answer is boy. Stockholders equity is B as in boy. Composed of the following. Common stock, 700,000. 700,000 is the sum of 200,000 and 500,000. 200,000 and 500,000 common stock. APIC. APIC, 22 million. 22 million plus the result of multiplying 50,000 by 30. So how much would that be? 50,000 times 30 is 1.5 million. And deduct 200,000. Cost to issue. Cost to issue. So your APIC, 23,300,000. APIC, 23,300,000. Next, retained earnings, 4 million minus 400,000. 3 million minus 400,000. That is your direct cost, ang 400,000. So 4 million minus 400,000 nga direct cost. 4 million minus 400,000 nga direct cost. So you have 3,600,000. Then we are going to add 100,000. We are going to add 100,000. Pangitaan nyo kung ano ng 100,000 nga gina-add ko. And you deduct 400,000. Add 100,000, deduct 400,000. So the difference is 27,300,000. 27,300,000. Okay? That ends question 2 to 6. Next problem is a very long problem. Question 7 to 13. 7 to 13. 7. Calculate the amount of consideration transferred. The amount of consideration transferred. Requirement to number 7. The answer is A. The answer is A. That's 92,000. Okay, how did we get that? Consideration transferred. Start. Cash paid. Cash paid. 85 million. Cash paid 85 million. New stock issued. New stock issued. 100,000 shares at 100,000 shares at 50 par. 100,000 shares at 50 par. To number 7. So that gives the amount of 5 million. 5 million. Okay? So we have now 5 million. Okay. Next. Earnings contingency. Earnings contingency. Earnings contingency. To be paid in 3 years. To be paid in 3 years. The present value is 2 million. 2 million. So the total is 92 million. That answers number 7. Now, to continue, we have to compute the goodwill. Compute the goodwill. And your goodwill, the answer is letter A. How did we find letter A? So, from consideration transferred of 92 million, deduct the market value of assets and liabilities, the net assets. Okay, 92 million. Then we have to deduct the net assets at market value. Current assets, 800,000. Current assets, 800,000. Tanawan nyo ang listahan. Current assets, 800,000. Plant and equipment, 10,000. Plant and equipment, 10,000. Patents and trademarks, 20. 10 million gali. So, bali ang imong nga cash, current assets, 800,000. Plant and equipment, 10 million. Patents and trademarks, 20 million. Then we are going to add Butler's franchise rights. Butler's franchise rights. Butler's franchise rights. 5 million. Next. Customers' contracts for consulting projects. Customers contracts for consulting projects, 1 million. Customers contracts for consulting projects, 1 million. Next, internet domain names. Internet domain names, 3 million. Internet domain names, 3 million. Customer order backlogs. Customer order backlogs, 1.5 million. Customer order backlogs, 1.5 million. Employment contracts, 500,000. Employment contracts, 500,000. Registered company name, 1 million. Registered company name, 1 million. Well-publicized internet domain name. Well-publicized internet domain name, 2 million. Trade dress. Please look at your book for the names. Trade dress, 1,200,000. 1,200,000. Next, proprietary databases of industry data. Proprietary databases of industry data, 800,000. Proprietary databases of industry data, 800,000. Next, trade secrets. Trade secrets, 400,000. Next, from the assets, you are going to deduct current liabilities, 400,000. Current liabilities, 400,000 deduct, and also deduct long-term debt. And also deduct long-term debt, 41 million. 41 million. The net market value of assets and liabilities, 5,800,000. 5,800,000. Extend under 92 million. Extend under 92 million. 92 million minus 5,800,000. The difference, amo na ang imo nga goodwill. So that is the answer to number 8. Answer to number 8. Okay? Okay lang kamo da? Kakatch up kamo? Ha? Okay? Can you catch up?
Yes, ma'am.
Yes, ma'am.
Okay. Number 9. The total assets in the balance sheet of DPSJ. The total assets in the balance sheet of DPSJ. The total assets in the balance sheet of DPSJ. The answer is letter A. Letter A. How do we find letter A as the total assets? Okay? DPSJ's assets before acquisition. DPSJ's assets before acquisition. 150 million. DPSJ's assets before acquisition. 150 million. 150 million. Less cash paid for acquisition. Cash paid. Less na ha. Cash paid for acquisition. 85 million. Cash paid for consulting. 12 million. Cash paid for stock registration. 600,000. Excuse me. Okay, let's continue. 150 million, we deduct 85 million, deduct 12 million, and deduct 600,000. Then we add assets acquired. The fair values of the assets acquired. Current assets, 800,000. Plant and equipment, 10 million. Patents and trademarks, 20 million. Butler's franchise rights, 5 million. Customers' contracts for consulting projects. Customers' contracts for consulting projects, 1 million. Internet domain names, 3 million. Customer order backlogs, 1.5 million. Employment contracts, 500,000. Registered company name, 1 million. Well-publicized internet domain name, 2 million. trade dress 1.2 million, proprietary databases 800,000, trade secrets 400,000, and goodwill that we have computed in number 8, 86,200,000. So the total assets in number 9 is letter A. Next, number 10, total liabilities. Total liabilities includes liabilities of DPSJ before acquisition. Liabilities before acquisition. 10 million plus 1 million. So 11 million. Next, earnings contingency. Earnings contingency to be paid in 3 years. Earnings contingency to be paid in 3 years. Present value is 2 million. Earnings contingency to be paid in 3 years. Present value is 2 million. Liabilities assumed. Current liabilities 400,000 and long-term liabilities 41 million. So we have now liabilities assumed, current liabilities 400,000 and long-term liabilities 41 million. So the total liabilities now in number 10 is letter C. C. Now you check on your totals. Check on your totals. 11. The answer to 11 is C. The answer to 11 is C. How do we get C? That's now the common stock in the balance sheet. C is the sum of 77,200,000 plus 77,250,000. That's letter C. The requirement in number 11 is the common stock in the balance sheet of DPSJ. The common stock in DPSJ, we just copy 77,200,000. 77,250,000. 77,250,000. Okay? Then number 12, the additional paid in capital. In number 12, the additional paid in capital, the balance sheet of DP is J. In number 12, that's for the amount of 40,550,000. 40,550,000. Next, number 13, the stockholders account after acquisition. That's letter A. That's letter A. 131,400 is taken as follows. Common stock, 77 million, 250,000. Add APIC, 40,550,000. Retained earnings, 8,800,000. Then we add 5,500,000 and deduct 700,000 and deduct 700,000. 131,400. That's the answer to number 13. Then numbers 14 up to 16. Numbers 14 up to 16. 14, letter C. 14, letter C. The amount of goodwill to be recognized is computed as consideration transferred, common shares, 81,600,000 times 12. 81,600 shares times 12. Common shares, 81,600 shares times 12 is 979,200. Add contingent consideration, 234,000. 234,000. The total is 1,213,000. 1,213,200. 1,213,200. Less fair value of identifiable assets acquired and liabilities assumed. Less fair value of identifiable assets acquired and liabilities assumed. 835,740. 835,740. So the difference is goodwill. Goodwill, 377,460. That's letter C. 14. Then number 15. The answer is D. 620,640. 620,640 for the expenses in number 15. Then we go to number 16. The answer to number 16 is letter D. 16, letter D. 558,900. Now, let me give you the computation for number 15, which will finally give 300, letter D. Number 15, letter D, 620,640. 620,640. So we start with consideration transferred in number 15. 540,000 for the common shares. 540,000 for the common shares. Then we add contingent consideration, 234,000. 234,000. Total is 774,000. We deduct the fair value of identifiable assets and liabilities assumed. Deduct the fair value of identifiable assets and liabilities. 835,740. 835,740. So the difference is 61,740. 61,740. That is the bargain purchase gain. That is the bargain purchase gain. 61,740 is the bargain purchase gain. Okay. Since the target was met, meaning the actual net income was greater than the targeted net income. Okay. Since the target was met, meaning the actual net income is greater than the targeted net income of 1,140,000. Therefore, the actual payment of the contingent consideration were as follows with this entry. Therefore, the total payment of the contingent consideration were as follows. Now, the entry is estimated liability on contingent consideration. Estimated liability on contingent consideration, 234,000. Estimated liability on contingent consideration, 234,000. Debit. Debit loss or expense. So loss, bar, expense. Loss, bar, expense on contingent consideration. Loss, bar, expense on contingent consideration. 312,000. 312,000. Credit cash. Credit cash of 546,000. Credit cash of 546,000. Therefore, the total expense as required in number 15 is 620,640. Number 15 is letter D. How do we find 620,640? By adding 42,720, 42,720, add 28,320, 28,320, add 96,000, add 90,000, add 51,600, add 312,000. So 42,720 add 28,320 add 96,000 add 90,000 add 51,600 add 312,000. That's now your total expense. Next, number 16. What amount to be chargeable to operations, profit or loss, net for the year ended December 31, X5, assuming that Jerry issued 45,000 shares? So the answer to number 16 is again letter D. 558,900. That's letter D. How do we find this? 620,640 in number 15. 620,640 in number 15. We deduct 61,740 bargain purchase gain. So number 16 is D as in dog. Next, number 17, C. 17 is C. How do we get C? That's the bargain purchase gain, 50,000. Acquisition-related expenses. Acquisition-related expenses, 20,000. Then we add accounts receivable, 180,000. Inventory, 400,000. Building, 50,000. We still have inventory, no, Liwat? Acquisition-related expenses, 20,000. Accounts receivable, 180,000. Inventory, 400,000. Land, 50,000. Building, 60,000. Equipment, 70,000. And patent, 20,000. For the debits. For the credits, current liabilities, 70,000. Long-term debt, 160,000. Then, we credit to cash for 520,000. So, we have now the gain to be or credit is 50,000. So if we do the computation of the gain on an entry basis, we have the balancing figure on the credit side representing gain on acquisition of 50,000. So that's now your gain. Number 17 is letter C. Then we go to 18 to 20. Numbers 18 to 20. Number 18, the answer is C. Number 19, the answer is boy. That's 19. The answer is boy. And number 20, the answer is C. Number 20 is C. So let's now begin with number 18. The question is, how much is the goodwill or the gain on bargain purchase? Consideration transferred is equal to common shares, 9,600 shares times 500. 9,600 shares times 500. So we have 4,800,000. 4,800,000. Deduct the fair value of identifiable assets and liabilities. Fair value of identifiable assets and liabilities. 7,680,000 minus 4,320,000. So 7,680,000 minus 4,320,000. The difference is 3,360,000. That's the fair value. So from consideration transferred of 4,800,000, we deduct 3,360,000. Now the difference is 1,440,000. That's your gain. We go to 19. How much is the total amount charged to profit or loss? The answer is 648,000 taken by adding 48,000, add 480,000, add 96,000, add 24,000. So 48,000, add 480,000 and add 24,000. So you now get the total of 648,000. In number 20, the question is, how much is the goodwill or the gain on bargain purchase on the business combination? So consideration transferred, the present value or the future value of bonds, 4,800,000. The present value or the fair value of bonds, 4,800,000. Less fair value of identifiable assets and liabilities assumed. So we have now 7,680,000 minus 4,320,000. So 7,680,000 minus 4,320,000. So the difference is 3,360,000. And the goodwill is 1,440,000. The goodwill is 1,440,000. That's letter C. Next for 21 and 22. Number 21, the answer is A. 2,240,000. The amount of consideration transferred. That's letter A. The consideration transferred is equivalent to the fair market value of the shares issued by Robin, 80,000 shares times 28. So 2,240,000. In number 22, the answer is letter B, as in boy, 520,000. The consideration transferred, 2,240,000. We deduct the fair value of net assets of Hope. We deduct the fair value of the net assets of Hope. 2,720,000 plus 200,000 minus 1,200,000 equals 1,720,000. Repeat, fair value of the net assets of Hope, 2,720,000 plus 200,000 minus 1,200,000. That gives us the difference as goodwill. Goodwill is 520,000, B as in boy. We go to number 23. The answer is dog, 848,000. That is your goodwill. So we try to determine goodwill by preparing a journal entry. So the balancing figure is goodwill. Debit, accounts receivable, net of allowance. Accounts receivable, net of allowance, 198,000. By the way, the allowance is 33,000. So accounts receivable, net of allowance of 33,000. Your accounts receivable at net is 198,000. Then we debit inventory, 330,000. Debit land, 550,000. Debit buildings and equipment, 1,144,000. Buildings and equipment, 1,144,000. Goodwill will be debited. That will be your balancing figure. So you leave that blank first and you compute. That will be your balancing figure. Goodwill is debit. Then we credit current liabilities, 275,000. Current liabilities, 275,000. Credit. Bonds payable, credit, 450,000. Premium on bonds payable, 445,000. Ang bonds payable mo mo ang 450,000. Premium on bonds payable, 495,000 minus 450,000. So the premium is 45,000. Then we have to credit preferred stock, 15,000 times 100. So 1.5 million ang preferred stock. Ang common stock is 30,000 times 10. So 300,000. That's your common stock. 30,000 times 10. 300,000. Credit paid in capital at par. Paid in capital par 25 minus 10. So you get 15 times 30,000. That's 450,000. Credit to cash, 50,000. Credit to cash, 50,000. So if you add the credits and you deduct the debits, you can already fill up the amount for goodwill. You add the credits and deduct the debits, you can already fill up the amount for goodwill. Fill up the amount for goodwill. So how much is goodwill? That will be your debit. Pila ang goodwill? How much is goodwill? Ilang goodwill, class? Goodwill in number
848,000, ma'am.
800 pila?
48.
848,000. Correct? 848,000. So you debit that. That's the balancing figure. You debit that to goodwill. Then number 24. Actually, duha diri ang 24. The first 24 is C. The first 24 is C. The second 24 is still C. Okay? So the first 24 is C and the second 24 is C. Okay. We go to the first 24. The answer is 450 goodwill. Again, we have the debits. Debit cash, 1,400. Debit receivable, 650. Debit investments, 1,000. Debit maintenance supplies, 400. Debit flight equipment, 12,000. Debit international routes, 500. Debit leases, 800. And debit goodwill, blank. Credit current liabilities, 3,200. Credit long-term debt, 6,000. Credit to cash for 8,000. So what will be your balancing figure? That's your debit to goodwill. What is your balancing figure? That will be your debit to goodwill. Pila? Pila?
450, ma'am.
Okay, 450. Goodwill is debit of 450. Now we go to the second 24, number 24. The letter answer there is C, 200,000. The gain on contingent consideration for Idina Company in 2006, assuming the earnings contingency was not met. So the answer is for the gain. We have now the gain on contingent consideration equal to 200,000. The gain on contingent consideration is 200,000. How do we find 200,000 here in 24? First, we debit accounts receivable, 220,000. Net. Debit inventory, 320,000. Debit land, 1,508,000. 1,508,000. Debit buildings, 1,392,000. Debit goodwill for 230,000. We are going to compute for this. Credit to accounts payable, 270,000. Credit to accounts payable, 270,000. Credit notes payable, 600,000. Credit to cash, 2,600,000, and credit estimated liability for contingent consideration. Estimated liability for contingent consideration, 200,000. Consideration transferred is 2.6 million plus 200,000, 2,800,000. Then from that, we deduct the fair value of net assets acquired. The fair value of net assets acquired, 3,440,000 minus 870,000. So 3,440 minus 870,000. So 2,570. Deduct that from 2.8. The difference is 230,000. That's the goodwill that we debited to 230,000. So your goodwill is 230,000. Debit to goodwill. Okay? So what does the problem ask for? In this case, we determine alternatively, you may have an entry. Okay? So we have now to debit. We have to debit the amount of estimated liability for contingent consideration. Estimated liability for contingent consideration, 200,000, and credit gain on contingent consideration. Estimated liability on contingent for contingent consideration and credit gain on contingent consideration. So we have now the answer to number 24. That's letter C. Okay, number 25. The answer is, let's finish up to number 26 na lang, ha? And then I'll stop and I can just give you the letter answers. 25, the answer is boy. 3,360,000 is the difference between 7,680,000 and 4,320,000. 7,680,000 minus 4,320,000. That gives us 3,360,000. Should be noted that possible future costs connected with restructuring or exit activities that may be planned by the acquirer and are not part of the acquisition and are expensed in future periods. Now you can refer to your book for this. Okay, you can refer to your book for this rule. I think we have the book there which mentions about. So number 25, boy. Number 26, the question is, how much is the goodwill or the gain on? So consideration received, 4,800,000 minus the fair value of identifiable assets of 3,360,000. Now we have a positive goodwill of 1,440,000. Now I'll give you the letter answers for the rest of the questions. Anyway, you try to compute and arrive at the answers given to you. So number 27, boy. 28C. 29, dog. 30, dog. 31C. 32C. Okay? 32C. Okay? Then, after number 32, tanay ka, medyo naka-problema ako di sa, what's the last number there? Oh, so anyway, hasta lang tadaanay ha. I'll give you the rest of the letter answers tomorrow. Ay do may ano ko di nga hindi gid mo. Okay? So, till tomorrow we are going to discuss module number 4. Tomorrow is Wednesday. We discuss module 4. And still on Thursday, we will still be in module 4. And hopefully answer some questions in chapter 2 by Friday. I will give you the test on Monday. So, any questions you have, please reserve it for tomorrow. We now end. It's already 12:20. Okay na? So, this afternoon, I just inform your classmates in the other sections. The afternoon and the evening classes, they just refer to the YouTube. Okay?
Yes, ma'am.
Okay, ma'am.
YouTube was kay ma-discuss ako module number 4 and some illustrative problems. Maybe we can have another YouTube postings by Friday. Okay. Bye-bye.
Bye,
Thank you,
ma'am.
ma'am. Bye.
Bye. 12 pa lang lagi.
Hindi mo pag-charge siya.